Hi, and welcome back. Today we're going to take a look at something that's fundamental to everything we're going to be doing in this course. We're going to talk about the basics of risk and return. Now, this isn't something that is really new. In fact, a lot of what we talked about in our previous finance course was about risk and return. And in that respect, a lot of what we're talking about today is going to be a summary and restatement of things that you already know. It helps us because we need to be able to make this explicit in everything that we do. When we compare stocks to bonds, or a high-risk growth stock to a less risky bank stock, things like that are always going to be about that risk and return. So today we'll talk about some of the ways that we measure things, the metrics for risk and return. None of these ideas are new, but we'll go over them again anyway. So specifically, some of our topics for today, we'll take a look at different ways of measuring return. And that's important because not everybody will be talking about the same thing when they're talking about return. And to compare, it's important that we're all using the same terminology, the same meanings. We'll compare the time-weighted to the money-weighted rate of return. That's something that we'll be testing you on later. We'll talk about what normal return looks like in the long-term and historical perspective. We'll talk about the way that we measure and compare risk. And we'll put it all together by taking a look at the interrelationship of risk and return across several different classes of assets. First off, talking about the nature of return. Time-weighted versus money-weighted rate of return. I don't know if you've heard about these ideas, but essentially they're just different ways of describing the rate of return based on the way we measure the timing of those returns. Time-weighted rate of return has been very commonly used by many investment advisors, is still used largely in the United States. According to the CFA Association Global Investment Portfolio System, they essentially are telling us that we can use different methods for different purposes. We'll talk about that later. Time-weighted essentially measures the account's performance over a certain period, ignoring the effect of timing and the size of different cash flows from contributions and withdrawals. The money-weighted rate of return measures your account's performance accounting for the timing of those cash flows, the amount of the cash flow, and includes the performance of the underlying assets. So time-weighted rate of return does not take into account those cash flows, while the money-weighted rate of return does. It sounds like time-weighted is a little bit easier, so we'll take a look at that one first. In this example, in fact, both the examples that we'll see today, we start off with an investment of $200,000 in a stock, in bonds, in whatever. Your investments do very well, and after about 8 months, the balance of your investment account is $220,000. So you've seen an increase of $20,000, 10%. By the end of the year, 4 months later, the account has a balance of $300,000, but that's partly because you put in an additional $50,000 in new investment on September 1st. So we treat this as two investment periods. Period number one, from January 1st until the end of August. Our initial investment of $200,000, that's subperiod number one. You didn't make any deposits during this period. Subperiod number two was after you made the second $50,000 deposit. And so from September 1st until December 30th, that's our second subperiod. And it turns out that your portfolio produced a return of 10% between September and the end of the year, December 31st. So essentially what we're doing is we're taking into account these two separate investments as part of our portfolio. This is the way that we're going to address that. We say the time-weighted rate of return is 1 plus the sub-period rate of return, and that was the 10%. And then we take that and we multiply it by 1 plus the sub-period rate of return for period 2. And then we subtract 1 to turn it back into a percent. So if you recall, we had a 10% rate of return for the first sub-period. So 1 plus 10%, that's the first sub-period. We multiply that by the second sub-period, 1 plus 11.11%, the rate of return for the last 4 months of the year, and we subtract 1 from that. Of course, that gives us 1.1 times 1.111 minus 1, or 1.22 minus 1, or finally 0.22 or 22%. So that's our overall rate of return for the year. Relatively simple to calculate, although as we mentioned before, it doesn't really account for the fact that we have had that $50,000 investment partway through the year. Our alternative is the money-weighted rate of return, and it's considerably more difficult to do. It's very, very hard to do with a pencil. We tend to do it with a calculator or with a spreadsheet. Essentially, it's analogous to the internal rate of return that we talk about in capital budgeting. It sets the present value of our initial investment based at the time period we're looking at, equal to the present value of all future cash flows, any withdrawals, as well as a final payout at the end of the period. So the future value of all cash flows, such as cash deposits, withdrawals, additional security investments, sales, and dividends. We could calculate that with our Texas Instruments calculator using the internal rate of return function and the cash flow input button. So on the second row, second from the left, you'll see a cash flow button. We would use that to enter each periodic initial investment, initial or secondary investments, and withdrawals. And then we can adjust that for the timing using the present value for the output, and that'll give us our calculation. I'll try to show you that in class if I can get my calculator working. I would much prefer using a spreadsheet than to use this, and that's how I would calculate it. So as I said earlier, essentially what we're looking at is an equation that sets the present value of our outputs equal to the present value of our inputs equal to, well, our initial investment cash flow times 0 plus secondary cash flows, either positive or negative, for period number 1, number 2, and for each of those we're going to value them at 1 plus the internal rate of return to the power of that time period. We're going to do that for all of those investment periods from time 0 right through until 10 years, 20 years, whenever we're going to stop measuring the fund. If we're looking at the simple investment we've made so far, we've said that our output number, the number that we have at the end, is $300,000, and that's going to equal our original investment, $200,000. That's why we have a minus, because it's money going into the fund. And then we have a secondary investment of $50,000. And now we just have to solve that to 1 plus the internal rate of return to the power of time. And if this is 9 months or 8 months, then that would be the 9th, 12th, or the 8th, 12th for that period. We could solve that iteratively over and over and over again until we finally found the internal rate of return that makes all of this work, that everything on the right-hand side is equal to the left-hand side by changing the internal rate of return. That's essentially what Excel does when we use the internal rate of return function on Excel. So in this case, I put some information into a spreadsheet. You can see my initial value at the 1st of January was $200,000. That's why it's got a minus. It's money I invested. It came out of my pocket. I also put a secondary investment of $50,000 in. That's why it's got a minus. It's out of my pocket again. And that was on the 1st of September. And then finally, at the end of the year, the ending value, 31st of December, was $300,000. If I would have had a withdrawal during that period, I would have put that number as another positive number into this table. So everything in those first 3 values goes in as the inputs to the equation. I specified that using an internal rate of return function called XIRR, and it tells me that the rate of return that makes all of this work is 23.27%. In fact, you can see the function on the right-hand side, and I'll show you this during our face-to-face class sessions. Essentially, I tell it, first specification, give me the information that is in the dollar value column, column D. So column D2, D3, D4. Those are the first things I specify. Second thing it needs to know, when did they get those investments? That's column C. So column C2, C3, and C4. Finally, it asks me to guess, because actually the internal rate of return function can create an error if you don't give it a little bit of a push, a little bit of help. So I say look around 20%. So essentially it says, with all that information, the rate of return that we solve for is 23.27%. We'll practice that one later. Now, the other important thing you need to know about these two different measures of return, essentially in Canada, we have used historically both of these methods, but since 2017, investment advisors are only supposed to use the money-weighted rate of return. Of course, that's because quoting the wrong rate of return can be misleading. You can see in the last case, the money-weighted rate of return was 23%. The time-weighted return was only 22%. So this time it would be to our benefit to quote the higher rate, but in other cases it might not be. Those are two of the first bits of complication that we have when we're talking about return. Return is essentially very simple. What kind of money back do we get from our original investment? And it usually takes two forms. We get income, like dividends or interest, and we get a capital gain, if there's a capital gain. Sometimes it's a capital loss. Important to distinguish those. So we measure those by talking about our rates of return. Sometimes we refer to this as yield, but essentially it can be expressed in dollar terms or in percent terms. Our textbook takes us through this step by step, but just to summarize what they're going to tell you, what they have told you if you've already read the chapters, total dollar return is the return on investment measured in dollars, accounting for all of the cash flows that happen in the interim, and capital gains. So for example, if on January 1st you purchase 200 shares of Harley-Davidson, which has an interesting ticker symbol, HOG, or HOG, another nickname for Harley-Davidsons. You bought the shares for $50, a total $10,000 investment. Now, from this we can calculate the capital gains, and we also have a little bit of information about our dividends. The initial value was $10,000 for those 200 shares. At the end of the year, the value had appreciated from $50 to $55.60. $55.60 times 200 gives us $11,120. That's our end of period value for our investment. The difference between $11,120 and $10,000 is $1,120. That's our capital gain. So that's how much you would have had as a return from the capital gain, but you also received dividend income. And the dividend income on your 200 shares was a total of $80. So the total return is $1,120 plus $80, $1,200. Now, $1,200 return on a total investment of $10,000. Is that very good? Well, if it was a return on $1,000, it would be fantastic. And if it was a return on $1 million, not so much. So to standardize that for the size of investment, we're going to use percentages. And percentage return starts off with the same information, the same company, the same stocks. So this is the percent return for every dollar invested. If our stock price was initially $50, our closing price was $55.60, our dividend income per share was 40 cents. We see our capital gain was $5.60 per share, plus the dividend income, 40, so that's $6 per share. The calculation in percentage terms would be to take the dividend income plus the capital gain, the end of period value minus the beginning period, and that is the numerator of the equation. In the denominator, we divide that by our beginning investment, and that turns it into a percent. So 40 cents dividends per share plus $5.60 capital gain, $6, divided by $50 initial investment gives us 0.12 or 12%. That's the percentage rate of return. 12%. That sounds pretty good. How does that compare to other similar investments? Well, we don't know that yet, but that's one of the things we'll talk about in a minute. We can put that into an annual rate of return, which is very simple in the last case because it was actually for 1 year. So 12% was our annual return. But what if we're looking at an investment over a shorter or a longer period of time? Well, for that, we're going to look at the effective annual return. And to get that, we do another similar calculation. So for a full year investment, we buy some shares, in this case in Cisco at $30 per share. 3 months later, you sell the shares for $31.50. No dividend income is available because not every company pays dividends. What's our return? Well, the return for the holding period, for the actual period that we own the shares of 3 months, takes the price at the end of the period, P sub T plus 1, minus P sub T, the price at the beginning of the period. So that was $31.50 at the end, minus 30. So we had a $1.50 capital gain. Divide that by 30. So that gives us a 5% rate of return. Is that good? Well, again, that's only for 3 months. So we could reinvest our money sequentially over time, or we could invest it in other things. What would the return be if we could earn an equivalent rate of return over the whole year? Well, it depends on the number of our holding periods. The calculation of that on an annual basis, and we talk about this as an annual return or an annualized holding period yield, is 1 plus plus that rate of return that we just saw, the equivalent annual rate. That is essentially equivalent to 1 plus the holding period percentage return, the holding period yield, to the power of time. In this case, the M is the number of holding periods per year. So if we had 5% as the holding period yield that we saw in the last slide, and we had 4 periods, we take that to the 4th power. So 1 plus 5% is equal to 1.2155. That's the factor presentation. If we subtract 1 from that, that tells us that 21.55 is the percentage rate of return. Better than 4 times 5% because of compounding over that period. So your rate of return for Cisco would have been equivalent to 1.05 times 1.05 times 1.05 times 1.05, or 21.5%. How good is a rate of return? It depends on the type of assets. It depends on the markets. It depends on other things like inflation. So if you were earning a 21% rate of return and there was a 25% inflation rate, that wouldn't be a terribly good rate of return. If you're taking a lot of risk to earn that, that would also be a factor. Our textbook shows us a comparison of the typical types of returns that we expect to see for different types of assets. And essentially, this is telling us, using some interesting information or a comparison on stocks going back to the early 1800s, right up till today. So for the last 200 years, if you'd invested $1 in stocks in 1816, and you left that money in the stock market and in a fully diversified portfolio of stocks, it would rise to a value of $28.56 million. If you put your money into bonds, you'll see that the line is a little bit smoother with bonds because there's less volatility and uncertainty. So your dollar would still be worth a lot. It would be worth $42,000, but not quite as much as for equities. Short-term government-backed or government-guaranteed instruments like Treasury Bills would produce a $5,000 rate of return. Put the money into gold. Well, that's a little bit more complicated because gold was guaranteed in value for a lot of that time. That's why it's so flat. But it would only be, your dollar would only be worth $66. And put your money into a basket of consumer goods. The inflation rate would have gone up from $1 to $21. So clearly the best rate of return is for equities, but for that you take a lot more risk. A better presentation, I think, of this is something that you'll see in a lot of investment advisors' offices. I'm not sure if Daniel's got one in his office, but I've even got a copy, an old copy, of an Andex chart. This is a long-term presentation, and it's done for each national market, of stocks, bonds, different types of investments over a long period of time. This starts off about 1950, and it goes through the last 70 years and is updated every year. Morningstar sells these through a subsidiary called Andex, and it tells us that $100 invested in 1950 in equities, small cap equities, would be worth $142,000. Small companies. If you'd invested it in average companies, the TSX 300, let's say, that could be worth $116,000. If you've invested it in different classes, well, you can see the dollar value. But underneath each of those numbers, you can see the rate of return. So an investment in the stock market would have produced about 11.2% average rate of return over that very long period of time. That's the geometric average rate of return. And we'll talk a little bit about that. But it does relate back to the holding period yield over 70 years. You can also see, of course, that there are other types of investments, and you do have to read the small print to see what each of these would be. But other types of investments like bonds and treasury bills that have much lower rates of return. On a class of asset by class basis, you can see from our textbook an example of how this works. Returns on large company stocks. Again, going back a long time, from 2018 back to 1926, you can see that on a year-by-year basis, annual average rates of return were quite volatile. Yeah, some people will remember 2008, for example, just after the 2006. There's a huge dip there. Really low, really big loss, negative value for a rate of return. Other years, much better. Some years as high as 40 or 50%, often following big drops. So it tells us that the rate of return, well, just looking at this says it looks kind of positive. And true, it is about 12%. On average over this entire period. Some years it would be hugely less, and some years it would be much more. It's even more volatile if we look at small cap stocks. And here you can see the axis is being relabeled, where before it went up to about 80%, I think. This one goes up to 200% rate of return. And in some years, back in the 1920s, small company stocks, growth stocks, could be expected to produce returns over 100%. We saw returns that were very high as well in the end of the 1990s because of growth stocks and those tech stocks. We also see very large dips, in fact, losing the market, not just individual stocks, but the market for small cap stocks, losing as much as 50% in a year. So there's more volatility, but a slightly higher expected rate of return. Bonds, here our axis is also quite a bit shorter. Bonds are much more stable in their payouts. They provide us with a guaranteed cash rate of return, but the price of the bonds might vary over time. So there's still some volatility, but it's not nearly as much. Treasury bills are very short term. They have to be renewed typically every 1 to 3 months. And so treasury bills also tend to be much less volatile. The only thing that affects them effectively is going to be inflation. So the yields would vary with inflation. They'd have to pay much higher rates of return in high inflation periods, like during the late 1970s. Inflation, of course, is always going to be a part of this because not all of our return is a true return to our wealth. Some of it is just a loss of purchasing power. And so this essentially becomes the thing that's used to standardize everything, the inflation rate. So consumer price index, another way that we describe this, or the inflation rate. Now, our historical average returns are useful to us because they help us to understand what normal return is. And investors always want better than normal. We actually describe this as alpha, the amount of alpha we can produce, the return in excess of a normal rate of return. So if 12% is the rate of return that we expect from a market, then 15% is 3% alpha, and we've outperformed the market. Well, in the long term, essentially we need to know what the average rate of return is. And it's much better to use the geometric rate of return. So if we just took the end of the period and the beginning of the period rate of returns and we just said, okay, well, what's that divided by the last 70 years? That would significantly understate the rate of return because return is compounded over time. That's why we start to talk about that geometric rate of return. So you can see the equation here for historical average return is essentially the sum of each year's annual returns. And the sigma, or the sum, tells us that we're going to take the returns for each of those years and divide those by n. That would give us the average return. We would use more like our holding period rate of return to figure out what the geometric rate is. When we calculate that for all of the different classes, and this is our textbook's version with the focus on an American market, it says that the best rate of return was for small cap stocks, smaller company stocks, those high growth stocks, 16.2%. The average return to larger company stocks was about 11.9%. Corporate bonds, good quality bonds, about 6%. Government bonds, less than 6%. Treasury bills, low risk, low return, 3.4%. In fact, they barely outperformed inflation, which is at 3%, long term over that entire period. We can compare that now to the risk and the risk premium for all of those types of investments. And not surprisingly, the type of investments that give you the highest return have the highest risk premium. So here you can see that there's 11.9% risk premium. That's return in excess of a risk-free rate. Small cap stocks, 12.8% in excess of that risk-free rate, and so on. So why do we require a risk premium? Essentially, this is what modern investment theory is essentially about. A fair rate of return for a certain level of risk. So we'll take a look at this much more so in the part of the course that follows. This is just an introduction to the topic. We can get a very broad idea of this by taking a look at the distribution or the dispersion of those returns over time. Kind of like when we look at our grades in some of the classes. Everybody gets a B plus, almost nobody gets an F, nobody gets an A. Other classes, a lot of A's and lots of F's and a small number of C's and B's in the middle. So there's more dispersion. There's a greater chance of ending up with an extremely high or extremely low value. So that's always about statistics. From the first finance course that you did through to this course, we've talked about that a lot, and it's important. So two statistical concepts that will be very important to understand risk: the dispersion, the variability, the variance, the standard deviation. And of course that axiom that we hear about always, that one term that we hear about in finance: the greater the return, the greater the risk. Now, I'm not going to tell you much about statistics today. I'll show you an example in just a minute. Essentially here we're talking about variance, the common measure of dispersion, and standard deviation, simply the mathematical expression of that, the square root of the variance. So square root is also described as the standard deviation is also described as true volatility. And it's handy because it puts all of our comparisons into a common format. Of course, most of what we talk about in basic finance courses assumes that distributions are normal. And essentially that says that we always expect to see a symmetrical bell-shaped frequency distribution that tapers away in the tails to nothing. Now, we know in some kind of investments that isn't always the case. We regularly see non-normal distributions. We see values, extreme values that are much bigger than we expect in the tails. So we assume a normal distribution, but sometimes that's a very poor assumption. Our textbook provides an interesting presentation of the way that a distribution might look with actual data from the 70 years of stock market information that we've just seen. In this particular diagram, you can see that on the left-hand side, we have some of the worst performing years for the stock market. In the left tail, you can see that 1931 was terrible with about a minus 45 or 50% rate of return, a huge loss for the markets. 2008 was almost as bad, so was 1937. Over on the right-hand side, you can see the two best years produced about a 60% rate of return, 1954 and 1933. As you get towards the middle, you can see that average years like 2016, 14, so on, were much more common. So you can see there is a kind of a bell curve presented here, but it's not strictly speaking exactly fitting that curve. In fact, we have some extreme values on the left-hand side, so it looks like it's a bit skewed to the left. And that's normal for stock markets, which are quite efficient. When we have infrequently traded assets like private equity and real estate, sometimes these normal distributions can look very abnormal. But we'll still stick with that standard assumption of the normality of distributions because it's pretty much all we've got for now. Here we can see a comparison of the distributions for different types of returns. Large company stocks, we do have more of a normal type of a distribution and a broad distribution. So there's a high amount of uncertainty. Even greater uncertainty, a flatter distribution for those small cap stocks. So higher average, the expected outcome of 16%, the normal rate of return for small cap stocks, but a much bigger distribution, much broader, much more values pushed out in the tails and less advantage to being in the middle. When we compare that to other types of investments like long-term government bonds, you can see the dispersion is much less. You pretty much get what you expect, so there's much lower risk. All of this, of course, conforms to what we saw earlier when we were talking about statistics with a standard normal distribution. So we'd expect that one standard deviation to contain about, well, in this case, about 68% of all of our observations, plus or minus one standard deviation. So if 11.9% represents an average year for the stock market, the expected outcome, and that's what the data that our textbook was using shows, one standard deviation would take that up by about 12%. That's one standard deviation plus, and one standard deviation below would take it down to about 7.9%. So this essentially gives us the view of what to expect, what risk would look like in investment in an average stock. Now, of course, no stock is strictly speaking average, but if you have a large enough portfolio, we can push towards the average by holding a distribution or a portfolio of different types of stock. We're going to talk a lot more about that in the weeks to come. So there's a lot of material that we're not going to get around to today. All of this course is about risk and return. A few things I'd like you to remember from today's session, from this video. Risk and return describes the historical patterns of returns. The returns that we've seen in the past with the assumption that the future will, broadly speaking, on average, look like the past. So future is predicted by the past. Also, it's about the probability of earning that historical average. Return is typically measured, in our case, using the money-weighted rate of return, so we have to have an idea of how that works. And risk is about the probability of return, based on past patterns of return, and again, the assumption that the distribution of those returns will look similar in the future. I hope that this has been helpful. It's meant to give you a taste of what we're going to be looking at in the next few weeks.